Hello, I'm Pete Sweeney. I'm Asia Editor of Reuters Breakingviews here in Hong Kong. I'm at our Predictions 2018 event, which is winding down, very successful. Anyways, I'm here with David Webb, famous veteran activist, investor, former regulator, and overall constructive critic of market structures in Hong Kong. So David, I just want to ask you, right now there's all this buzz that Hong Kong markets are transforming themselves into a more attractive place for technology companies and foreign companies to list. There's talk about Saudi Aramco listing, which would be huge. There's also been recent chatter about Alibaba maybe having a secondary listing here. Say, for example, you were going to talk to the boards of these companies, kind of present the ups and downs of the Hong Kong market to them as a place to list and a venue for investors. What would you say?
Well, I wish I had a better story to tell them. I would like to be able to say to them that Hong Kong has always striven to achieve the best in corporate governance and thereby build a framework of trust in which investors will pay a bit more for stocks because they feel they're going to be fairly represented in the boardrooms and get frequent quarterly reporting and have a class action rights system to as remedies. They don't have any of those things, unfortunately, and HKX wants to head in the opposite direction, racing to the bottom by introducing second-class shares to list on the board.
Is that a done deal, the second-class shares? Do you think that's...
No, it's
not
not
a done deal. That's been the argument of all years, like that's settled? Or?
They had a concept paper proposing a third board for these companies, and it only concluded in December that they wouldn't do that. And then they said instead they would like to introduce second-class shares onto the main board and secondary listings of companies from overseas as well, using the main board. And that's still something that the SFC could say no to. They said no in 2015 when the issue of second-class shares last came up. They said it would be very bad for the market in terms of corporate governance. And it's a very simple thought experiment to ask any investor. If you had two otherwise identical companies, one of which gave you no board representation and no prospect of ever changing control, and the other one said it's exactly the same company, but you have one share, one vote, and the public will hold a majority of the votes, which one would you pay more for? Most people will very clearly say, I want the one which gives me the possibility of getting rid of somebody who is currently a star CEO, but in future may not be, and of having the company taken over by someone better.
Well, I mean, and standing behind this is the China market, and obviously Aramco, Alibaba are two companies, but you've got this massive push by Chinese technology companies to find a venue to list, and they can have dual shares in the U.S.
Yeah.
They want it in
That's
in
not
the
the reason they went to America, though, because the biggest company in Hong Kong, by the way, is a tech company. Undoubtedly, Tencent is bigger than all the others. And we've had some very successful single-class share listings of China Literature and other companies that people would call tech. Of course, technology today is old-fashioned tomorrow. There was a time when motor cars were high-tech. There was a time when railways were high-tech, if you go back through market history. But we don't see lots of Chinese property developers, for example, listing in America for dual-class share reason. They could have done that. They're quite happy to list in Hong Kong with a single class. There's only a few insecure chief executives who, through pre-IPO venture capitalism, have lost their voting controls and want to somehow get it back by having a privileged set of rights when they come to market. And even amongst them, if you look at successful US tech companies like Apple, Microsoft, Intel, they have a single class of shares. Their founders and chief executives have done very well over time, and they're not worried about that situation. You don't see them looking to introduce a second class of shares and inflict that on their shareholders.
I mean, and there's another trend that's underway, right, which is the increasing influence of party cells within listed companies, including private and state-owned companies in Hong Kong. How do you see this playing out for investors in those companies?
The bigger issue, what you're alluding to, is the fact that the state is trying to tell state-owned enterprises to give the Communist Party committee in each company a more formal role. In reality, of course, they were already state-controlled companies, but the bigger question is, why are they still state-controlled companies 10, 15, or even 20 years after they listed? Why isn't it the case yet, if China believes in the free markets and market reforms, that it isn't selling off the controlling shareholdings, along with other social liberalisation in terms of what you can read on the internet, what apps you can get, whether you're free to travel outside the country, and all these sorts of things. If they're not pursuing those liberalisations, I don't see how they can become a truly prosperous nation and keep generating the economic growth that they did in the last 30 years in the next 30 years, because they did the easy things from centralised communist economy and and the hard things have not been touched and should have been touched 10 years ago.
Well, in terms of reform, they're certainly not the only ones who are kicking the can down the road, markets-wise. That's David Webb. You can find his thinking on Webb-site.com now. It's with two B's.
That's it.
Thanks so much.